following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
And now, it's time for the show that breaks down the options market. From unusual activity alerts to market updates and trading strategies. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block. With your host, Mark Longo from theoptionsinsider.com and co-hosts Mike Tusaw from KnowYourOptionsInc.com and Mark Sebastian from OptionPit.com. The Option Block is brought to you by Options Express. Don't spend time worrying about your broker. At Options Express, security, stability, and account protection are the most important responsibilities to our customers. Secure account access, enhanced financial protection, entrusted with over $7 billion in customer assets, established financial stability. Options Express lets you trade with confidence. Stocks, options, and futures, all in one account. Trade with a specialist. Visit optionsexpress.com/OXradio to open your free account. Options Express is a member of FINRA, SIPC, and NFA.
All right, and that rockin' tune means it's time once again for the Option Block, your bi-weekly source for all things option. My name is Mark Longo from the OptionsInsider.com, as well as the old Options Insider Radio Network. And I'm very pleased to be kicking off another week of Option Block here on the old Option Block All-Star panel. And joining me on the panel today is fresh back from his vacation in sunny Cape Cod, is good old Mark Sebastian from OptionPit.com. Mr. Sebas, welcome back to the good old center of the country where you belong.
Oh, it's nice to be back in flyover country. It's the best.
What prompted you to hit the Cape in October? Not exactly Cape season.
Anniversary. I wanted to do something different, so we spent a night in Boston and then 2 days out on the Cape. And then spent the day back in Boston on Sunday before flying back home. It was really lovely.
It is nice country out there. I haven't been out there in a number of years, but I grew up not that far from there.
It was really cool. I really enjoyed it. I love the beach in the fall, a lot. It's just a great place to be because it's not too cold. The beach is pretty. It's just nice. So I was very pleased to have gone, and we just had a great time, and fresh off. It was the lobstertrader.com's idea, and
somehow it doesn't surprise me. And of course,
Lobster Pit.
Of course, that should be your new domain. Let's just switch all the branding over to Lobster Pit.
Lobsterpit.com.
You can kill two birds with one stone. Talk about options and also how to freshly crush your lobster claws the proper way.
Lobster is really cheap right now. I don't know if you've heard about this, but I guess they're having like a banner lobster year. And so the market prices for lobster are basically at near all-time lows.
I believe Andrew was telling us something about that on an earlier show. It's like, yeah, you can fill up your tank with lobster oil up in Maine now. It's so cheap. It's like Kuwait. They're a mini little state floating on their one prominent national resource and loving it. And listeners, we'll be joined a little bit later by good old Uncle Mike Tusaw for our interview block, where we'll interview someone on the dark side, the future side over at KYO to illuminate you on some of the interesting topics he's going to highlight on his upcoming webinar over there on the KYO webinar train tomorrow.
Well, it's too bad. Mike's hemorrhoids kind of flared up on him, so
yes.
he's getting himself fixed, though, folks. Don't worry.
He'll be back in prime shape for Thursday's show. Until then, you have to make do with Mark and I. The OX boys also swamped on this busy day here in the old market, so just me and the old greasy meatball today, but we'll hold down quite a show for you today. And speaking of which, it's time to get rolling with that show right into the trading block.
The Trading Block.
All right, and welcome to the old trading block. This is, of course, where we touch on what was trading, what was moving the old markets today. And we actually had a wee bit of activity today to speak of. Most of the major indices closing up on the day. S&P closing up nearly a full percentage point, or about almost 12 handles to 1440. The Dow up and the NASDAQ both up about 0.7 of a point today as well. And not surprisingly, given what we talked about on last week's show going into Friday's session, about what we saw with the inflated levels of VIX going into the weekend, an unusual event to say the least. We all kind of expected VIX to come off today, unless the bottom fell out of the market, and certainly that did not happen. So VIX, I think, performed as accordingly, down about 5.5% to about 15.25 today. So let's start there, Mark. All of us on the show, you weren't on the show on Friday, obviously you were on vacation, but all of us on this show, and particularly VolViews on Friday, really just thought VIX was going to really take it on the chin this morning if we saw some good earnings from Citi and whatnot, and certainly we did. Citi pretty much lifted the whole market today and just gave VIX a 1-2 punch to the nose. Probably not really too unexpected for you, I don't think, given what we saw going on Friday, right?
No, I mean, I just put this out. We got what I like to call a fully hedged market. Realized volatility on the 10 and 20 over the last 10 and 20 days at 7.9%, about half of the VIX and a third of long-term VIX futures. This market is so collared out the wazoo. It is unbelievable. And that's going to make any kind of extended sell-off extremely difficult. And it's really going to put pressure on anybody trying to be short. Until we see a major move, breakthrough in one direction or the other, I mean, I just do not see how we're able to get a major sell-off. It's funny. We can't get any real vol until we get some real vol. Does that make sense?
It's the old catch-22 of the marketplace.
Yeah. If and when we actually see a real break, I will buy it. We have not moved more than 1% in over 4 months now. All right? I mean, think about that. Yeah. You can pull up a 3-month chart and not see a 1% down move, let me clarify, and not see a 1% down move over the last 3 months.
Yeah, most of the vol we talked about on this show in the past has been to the upside, really. And, of course, today, that's probably the ultimate irony of today is that we had realized vol to the upside again today. That's really the only place it comes from these days, which is kind of weird. And that does kind of put us into that weird nebulous category like you talked about where people are hedged.
I think it's caused by collaring primarily.
We talked about this a little bit on VolViews last week because someone wrote in with a specific question. Maybe we can chat about it here a little bit too because you weren't on the show on Friday. Just that interesting scenario that sets up where people are either collared with S&P puts and they're writing calls against it, or just downside put spreads, or in some of the more extreme conditions, maybe perhaps some of the more, I hate to call them sophisticated, but perhaps knowledgeable in the marketplace are using VIX verticals or something else to hedge with. There's a plethora of hedging options out there, but at least the bulk of the people who have some sophistication in this sense seem to have taken advantage of the current opportunities to put those positions on. And now we're seeing, yeah, you're right, this kind of weird marketplace where we can't really get a good pop to the downside, and that's what we really need in order to get this VIX to get some gas in it again.
The interesting thing is when you're collared, and that's actually what's causing the volatility of the upside. Because when you're collared and you have to chase returns, what happens once you start getting near that short call? Well, now you've got a short gamma problem. You have to chase deltas. And what happens? We run the stock market higher. So believe it or not, I think that collaring is causing this upside volatility.
It's an interesting thought, because we see typically a lot of people doing the downside puts. Some of the other ones are using the collar. And I wonder how prevalent and pervasive that collar end of the hedging spectrum is to really drive that upside. But it's certainly, among the theories I've heard, it's certainly one of the more plausible. There's a lot of other things. You hear people talking about all these crazy VIX ETPs that are by definition short tons of gamma and vol out there.
I don't think that's it. I really don't. Because all they have is a little, all they have is a little document that says what they have to hold. They're not out. I really don't think it's the ETPs. I think it's, it's chasing returns in a lot of ways.
I shouldn't say VIX ETPs. I should say S&P ETPs to clarify, because that's where a lot of this stuff is coming from. There's certainly a larger universe of those than there are VIX ETPs, even though the latter is growing quite a bit. But yeah, interesting idea, the notion that I wonder how many of these managers out there, given how we talked about so many times on the show about how just completely, complete novices they are when it comes to options, how many of them even realize what to do when they get to that short strike. They probably, a lot of them just let their stock get called away because that's all they know how to do, The same thing was when this runs to the downside. What do they do with that put? They probably don't sell it out. A lot of them are probably just using it for that insurance purpose that they want, and they actually breathe a sigh of relief when it bounces off of that. They don't have to actually let the put work for them. Not a lot of these guys, I don't think, actively trading these options in and out, selling out the put when they drop, rolling the call up when they rally. They're probably just letting that position roll for them. But it's probably written like 3 or 6 months out, and they just forget about it,
Yep.
Which is that thing we talked about quite a bit as well here on the show, them failing to maximize the theta component of those options when they're writing them for maximum impact. But interesting stuff. Yeah, so we're kind of in this weird nebulous place now. Where do we go? We rally a little bit higher. That gives us a little bit of realized vol for probably a combination of a number of reasons. Maybe it's a short ETPs.
And then we're going to creep higher. I mean, I'm telling you, we've got, I keep coming up with analogies for this, but it's kind of like a Peter Griffin earnings season. We're expecting the absolute worst.
So we're going to have random pop culture references throughout the earnings season. Is that what we're going to have?
Exactly. No, it's not. We're expecting the absolute worst, and when we just get bad, we rally. And that's kind of what we're seeing. And until with combo of free money from the internet and better than expected expectations, we're going to rally.
I like the idea of a Peter Griffin earnings cycle. That to me says something like Alcoa announces, but Lady Gaga is on the call or something too, something absurd, doing the aluminum aluminum
this
announcement.
Is like Alcoa. This earnings cycle is worse than the time I, got in a boxing match with Mike Tyson. Or no. Yeah, I went to an ear barbecue with Mike Tyson.
Yeah, and then they flashed back to the CEO of Alcoa and Mike Tyson in earlier days.
Yeah. Yeah.
Well,
this is worse than I bet Mike Tyson. He wouldn't bite Evander Holyfield's ear.
There are some other things going on today. Interesting stuff. On a side note, I just noticed today that the Nobel for Economics was announced this morning. It was some guy, Alvin Roth, who actually designed some interesting, also controversial matching principles that supposedly can help to use more, guide marketplaces. A lot of people think they're kind of a dubious measure. But I thought the best thing I saw about this morning came out of Forbes. They were writing a synopsis of the Nobel Prize, and the writer threw in what I think is the best quote, the best summarization of the Nobels I've ever seen. He wrote, "There's a larger question here about why the scholarly world allows itself to be judged by secretive Scandinavian committees sitting on endowments funded by money made selling explosives." And that, to me, sums up the Nobels better than anything I ever could have said about that topic. I thought that was just fantastic. So, not really options related, but I had to throw it out there. It's just too good.
Well, and let's not forget this. Paul Krugman has a Nobel Prize for economics.
Yeah, that really kind of killed it for me when he won.
Yeah, the fact of the matter is that if you look at the record, it's leftist. The first half of the century was proving communists wrong. Now they're going to spend the next century going after democracy and capitalism.
And they took so long to give one to, Black and Scholes, who actually made some fundamental contributions to the marketplace, and they give them to people like Krugman and other things like that. And regardless of what you think about his political leanings, his economic body of work is certainly not that impressive, at least not to me.
No, it's terrible.
So it's just a weird setup all around. I thought that was a great summation of the Nobels.
Yeah, exactly. So,
but that again, just summarizing our feelings here on the old Nobels, and that's going to do it, I think, for the Nobel block. And we're going to dive right into the odd block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the odd block.
All right, and welcome to the Odd Block. This is where we highlight some interesting and or unusual options activity that's lighting up the old tape today. If you want to learn more about this or any other unusual activity going on today, then I encourage you to surf on over to theoptionsinsider.com. We have full write-ups on these as well as a number of other unusual items on the site with much more detail and analysis than we can go to here in a few minutes on the show. But we like to give you the highlights, starting off with Two Harbors Investment Corp, ticker symbol 2, TWO. This is a real estate investment trust. They essentially invest in and finance residential mortgage-backed securities. We know that's not exactly a risky marketplace, not at all these days.
Not at all.
Nothing bad could happen there. This name took a bit of a beating of late, and today it actually hit a 200-day moving average here. It hit the 1077 at one point today, which was a low for quite a while. Then it just bounced back dramatically, closing the day, ending up only down about 1.7% to about 1150 on the day. So Two Harbors, this is a real estate investment trust. And today they saw some dramatic action. They dropped down all the way down to like 1077 at one point today, which is about coincidentally their 200-day moving average. And of course, I guess the technical traders kicked in at that point because the stock bounced back dramatically to close at around 11.5 today on the day. And in spite of this strong selling today, we saw a lot of people really piling in to some upside today, thinking that perhaps this dramatic sell-off is overdone here in two. This is the name that usually does a little over 1,000 contracts a day. Today they did 5,500, the bulk of that coming in some large buying, at least large for this name, on the D12 strike.
Yeah.
We saw about 2,000 of these D12 calls going up earlier, lifting the offer this morning for about 25 cents. They went out 20 at 30, a total of about 2,800 on the day going up on this strike.
My guess, that's a hedge against a short. What do you think?
I don't know. This kind of size and a name like this, it usually does indicate something else going on other than an outright spec.
And naked cheap call buying on a stock that's been dipping.
Yeah, that could certainly be the case here.
That's got to be that.
In fact, given the rally we saw today in the underlying, this guy might have just been chasing some deltas to the upside, and perhaps he saw the stock was gapping up. He can get a little bit more liquidity and probably a little bit better level in the options than he could in the underlying. This thing ran 70 cents in the space of a few minutes. Obviously, someone was gobbling up deltas in the underlying as well. He probably hedged his bets or picked up some extra by chasing some of the deltas in the options as well. As you can see, there's some decent liquidity, even in a thin name like this. He bought a couple thousand of them for 25 cents. They went out 20 at 30. So it's not a bad way to get some deltas if you need them. He took them up out in December, so he gave himself some time for this name to run. Not surprisingly, the vol was up quite a bit to about 26% on the day today, almost 27%. That's up substantially from south of 20 just a few days ago. And they have earnings coming out actually at the end of this month. So that's not exactly an earnings play. Earnings will be baked into it, but it's not a straight-up earnings play here on two. A newcomer to the old option or the old odd block. We'd love to welcome in the newcomers. And now we're going to go off to a frequent visitor on the old odd block. This is XLV, of course, the Healthcare Select Spider. This one was also up a bit today, up about 1.5% to close at nearly 41 on the day. And this is a fairly active name, as you might have guessed, doing about 12,000 contracts a day. It did almost 52,000 today, and this was where a lot of the trading was going on the put side. We started off when this was first written up, our editor first wrote this up for the site, a lot of the action was on the D38 puts. This is where the bulk of the activity was going up. They went up about 6,200 times, lifting the offer for 31 cents. That was about 3 times the existing open interest on that strike. So it was all fresh positioning. Then what was interesting about that is a short while after that was written up, the first time you went back and updated it because we saw some other activity going on later that was also interesting in this. So shortly after those D38 puts went up, we also saw someone coming in and gobbling up 20,000 of the very long-term Jan 2014 50s here on the old XLV, lifting the offer on those again for about 12 cents. The open interest, this volume was well past the OI on that strike. So there's some strong upside love here. So could be probably two separate trades going up, or it could be someone hedging an existing position and then looking to perhaps add some upside if his existing XLV underlying position pops and getting a cheap pickup on some far upside on this upside, or it could be two unrelated bets. Of course, given that kind of size in this name, the chances of them being completely unrelated are perhaps small, but still an interesting one nonetheless.
Yeah, I don't know.
If I had to guess, I'd probably say it's someone who owns a bunch of XLV, hedging himself in the near term, and then he wants to add some upside for just maybe some grins, and so he adds a kicker. 12 cents.
Well,
it's a pretty reasonable level.
It's like an Obamacare bet.
Yeah, or you want to think of it as a ratio strangle. Whichever way you want to look at it. This guy obviously seeing some, you're right. This is obviously clearly a hedge against Obamacare imploding and a spec to the upside that Obamacare is going to be off to the races. Interesting stuff going on here.
An election strangle, if you will.
Yeah, there you go. An election ratio strangle. I think we'll write it up as that. Last up here on the old odd block, this is a continuation of a name we wrote about last week on the site and talked about on the show, actually, Wells Fargo. Of course, you guys know Wells Fargo Financial Holding Company. They closed today down about 1% to $33.90. This is the name that's been doing some fairly decent volume of late, about 63,000 contracts, and that's relatively inflated in and of itself. And then today it did over 110,000 contracts with some very, very sizable activity. If you remember from last week, we talked about someone coming in and gobbling up some very near-term puts. They were the OC 34 half puts, were picked up about 4,000 times for prices ranging about 20 to 21 cents. Though, of course, that trade worked out pretty well. Those are trading now for about 90 cents. So that trader looking pretty good on those trades we highlighted last week. And then today we saw someone coming in with some fresh positioning on some October puts. This was the OC 35 put that was traded, picked up about 17,000 times, lifting the offer for $1.20. This guy was actually legging into a calendar today, just as he sold these NOV 35 puts 17,000 times, also for about $1.68. So he actually collected 48 cents on this calendar spread. It looks like, we're not totally sure, obviously we haven't seen all the open interest updated yet, but it looks like this could be fresh positioning, not just a roll of existing open interest. So Mark, if you're looking at this as fresh positioning here, what do you think of this calendar here in Wells Fargo? You watch this one at all?
You know, Fargo's an interesting one. I mean, the vol's dirt cheap. You know, it's not a bad little spread, right? I mean, if you think Fargo's gonna rally a little bit, you know, I think this one was a roll back. But on its own, it's an interesting little spread. If you think movement's gonna be a little slow, and that vol's gonna maybe tick up a little bit, it's not a bad. I don't think it's a bad trade at all.
Yes, but an interesting trade. It could be, given the open interest, you never know. It could be a closing of this OC 35 position, at least partial here as well. So we'll have to really wait and see. But it looks like it could be a roll or it could be some fresh positioning. I'm probably going to lean towards the latter, along with our unusual activity editor here on the site. And that's going to do it for the old odd block today. Like I said, if you want to check out more detail on any of those listings, as well as the numerous other unusual activity write-ups we have on the old site, then surf on over to theoptionsinsider.com. You can find it a number of different ways. You can click on the unusual activity tab there on the top of the page. You can also see right on the top of the page is the unusual activity call-out section, where we'll highlight two of the most recent unusual activity articles right there on the homepage for you to find. So there's a lot of ways for you guys to check out the latest and greatest unusual activity from the options market. All right, and because the boys from OX can't join us today, we're going to skip the old Express block and roll right into the interview block.
The interview block.
All right, and welcome to the interview block. This is hopefully a trend, 2 weeks in a row. We haven't broken out the old interview block in a while. Now we're getting it back into the rotation, and today's guest is Kevin Davitt. He is the futures specialist, the futures guru over there at KYO. Kevin, welcome to the program.
Thank you for having me.
And now, since you work quite a bit with good old Uncle Mike, I'll let him run with this. and I'll dive in as necessary. Uncle Mike, take the reins, sir.
Sounds good. First off, what's the capital of South Dakota? Just kidding.
Wow, Pierre?
Yeah, it's Pierre.
Very good, very good.
Kevin,
it's great. I think you're right. Kevin, it's great having you on the show. Hey, just tell us a little bit about your background, what you do with futures, and I think I've been talking a little bit with Mark Longo's birdies, and rumor has it that you might be doing a webinar one of these days.
That is right. I am doing a webinar tomorrow evening, and specific to background stuff, I actually come from an equity options background. I spent about 7 years on the SIBO floor, a year out east, and I've been working specific to commodities since 2008. Kind of top ticked that market right around when Lehman Brothers went under.
What a great time to enter the business.
I'm sorry, what did you trade over there at the SIBO?
I mean, over the years, probably a couple hundred equity issues, but the bulk of my time for 3.5 years, I traded the Russell.
Okay, that's probably why we haven't crossed paths then, because I did a bunch of different products, but never the Russell. That's one of the few I didn't have on my list.
What years?
This is the mid-'90s until about 2001, about a week before 9/11. So we didn't cross paths from a time either.
Gotcha. I was a Letco guy, so we had a lot of DPMs.
We didn't talk to you Letco guys. We looked down our nose at you Letco fellas. No,
of course.
I'm just kidding.
You just let it go.
So tell us a little bit about this webinar you have coming up. What's the gist of it for our listeners that may want to check it out?
I'm hopefully going to give kind of an overview of commodity options in general, draw some similarities or comparisons to those that spend the bulk of their time looking at the equity side, point out some of the idiosyncratic things that are unique to commodity options, and then talk specifically about strategies that arguably could be applied, stuff that's probably familiar to a lot of your audience already, and just put it in commodity terms.
You know, what's exciting about this is that a lot of our listeners I know are more on the equity side of options, and Kevin actually has a very strong background on the equity side himself, but now he's on, as we like to refer to it, as the dark side. I think this is going to be a really good educational opportunity for a lot of our listeners. Now, Kevin, what are some of the things that you're trading with your clients at this point in time? Like, are you looking in more in the grain options? Are you looking more at the metals, or what are you looking at right now?
That's a really good question. I would say from a background standpoint, I'm most comfortable talking about energies, metals, indices, and currencies. Things like the grains, meats, and softs generally play second fiddle. Maybe that's a function of volume or kind of the role that the physical market plays versus kind of risk on, risk off trade. But the bulk of the options trading that I do with clients is energy, metal, indice, and currency specific.
So tomorrow you're going to walk through things like, the difference between investment skew versus commodity skew and how that might impact the typical equity option trade, like a covered call or a vertical or things like that?
You got it. There were, as you likely know, plenty of guys when things started to change dramatically on the options side of the market making business that would go across the street and they would look at grain skew and say their natural inclination would be to get short upside calls and long puts because that looked out of whack versus what they were used to in the equity world. And that can be because some of that idiosyncratic commodity risk detrimental to your bottom line. So short answer, yes, absolutely.
Now, Kevin, typically a lot of times with your clients, I know we've talked a few times in the past, you like the ratio spread quite a bit. Can you tell us a little bit more about like some of the things that you look for when you're looking for a ratio spread, like in oil or nat gas or something along those lines?
Sure. The ratio is something I'm friendly to for a variety of reasons. Setups that I would find appropriate for a ratio would be if you'd like to take a directional leg, but ideally don't want to have outright futures risk, which can be noisy, and you can get shaken out depending on you can easily get shaken out depending on your stops, and you're not looking to, if you're wrong, have a lot of dollar risk involved. And I would imagine that most of your audience knows what I'm alluding to there. There's a volatility component and a naked option, so that's not necessarily for everyone. But I mean, just in simple terms, you brought up crude right now, which I would argue is fairly range bound, 87 on the downside, 93 on the top side. If somebody had the inclination to lean either long or short, you could look at a $5 wide ratio spread, say 6 weeks out, and hope to get that on for around even money, depending on how implieds are trading. And
so you'd be looking to maybe buy the 90 call and sell 2 95 calls or something along those lines?
Sure. I mean, if
vice versa with the puts.
Absolutely. You can just tailor it depending on kind of the area you could see a market move into. And it doesn't require a whole lot of babysitting so long as you don't get a big break in that direction early in your expiration cycle.
And that's interesting because I know also a thing that I know I've seen you do this in the past. A lot of times you'll actually trade these as like position one, but occasionally you'll turn these into a butterfly if the market gives you the right look to do that. Can you tell us a little bit about that whenever you kind of turn these into butterflies at times?
Absolutely. So say you enter into, let's just use put ratio for this example. You're long one, you're short two, and you get a couple of weeks that go by, say 2 weeks on a 6 week option. And rather than be concerned about getting that big break lower, you can buy your, just because we use the example, say you were long the 90 put, short 2 of the 85s, and then the 80 puts were trading for a dime. You can tourniquet all your risks by buying that 85 put for a dime and work yourself into a butterfly for a very small debit, which it's hard to get hurt too bad if you're able to do that month after month. That makes sense?
Yeah, I got a question for you. This a little more tradery about kind of what's going on in the oil market right now.
Sure.
What do you think about the relationship currently between implied and realized vol, historical vol? We've got the OVX/CVF actually trading at a discount to how oil is really moving. What are your thoughts on why that's happening and how someone might be able to trade that?
When you say OVX, you're just talking the oil specific vol index?
I'm talking about the OVX/CVF is the futures oil vol contract.
Okay. Well, of late, we've seen, or I've noticed, periodic pickups in crude vol. The range over the past 3 weeks has been like 27 on the low end and 35 in terms of nearby option volatility in the crude market. You've seen risk flares with Iran headlines, with sometimes around inventory numbers, but you haven't, again, in my experience, you haven't seen a great deal of realized volatility with the exception of the break about a week and a half ago. So from my standpoint here and now in crude oil, to me, it seems like we're range bound until the market breaks out either above 93 or below 87. I would be inclined to be short a bit of option premium depending on your kind of risk appetite. I'm not sure if that answers your question, but from a vol standpoint, if we're trading around 34, 35 on near-term implieds, I would lean a little bit short of that premium when 20-day historicals, I believe, are around 28 in crude. And I mean, the textbook would tell you that maybe there's an opportunity there.
Now, Kevin, I think another interesting topic for tomorrow, and I'm curious if you're going to bring this up as well, because we certainly receive a lot of these types of questions here at Options Insider, are a lot of these equity options people, when they first start to dally with commodities, they typically take an ETF approach. So you're going to highlight maybe some of the differences in trading ETFs and ETF options versus futures and futures options, and perhaps some of the benefits and drawbacks of each in your webinar tomorrow?
Yep, really, really good question, and I think you're absolutely right. The explosion in ETF interest has made what I venture to do as a commodity broker a bit more difficult. But if you do some digging or you're open to it, there are situations where the ETFs, I think UNG is probably the best example, because of term structure, do a poor job of kind of replicating the underlying, if your interest is nat gas, or other situations where just from a trading hour standpoint, from a liquidity, from an access standpoint, you're limited in the ETFs to your 8:30 to 3 o'clock Chicago markets, whereas a lot of the commodities are open 23 plus hours. And so that's when you see some distinctions between realized volatility in something like USO and crude oil itself, or GLD and GC volatility. And then furthermore, if you're just looking for efficient, or if you're trading 10 lots in GLD, you're going to get the very same bang, if not more, for your buck in GC, albeit with a slightly different expiration cycle. So long-winded way of saying, yes, those are all things that are hopefully going to be covered tomorrow, and things that you need to be aware of before taking that leap into the dark side, or the commodity side.
That'll be interesting, because I know Sebastian's a big fan of UNG options.
Oh, yeah. UNG is awesome.
Mm-hmm.
I've been
reverse splits are great.
That's a good one to be short. US, it's interesting. Have you looked at a couple of these new grain ones that are there was actually some thought to how they were constructed. It's really interesting. Corn and soybean are both kind of interesting, but you're right. And it took them a while, but they finally got USO, so at least it's only cruddy instead of downright terrible.
Well put.
UNG, though, I think still has a lot more problems than some of the other ones. But yeah, I agree. If you're really interested in commodities, you shouldn't be trading the ETFs. You should either be trading the stocks that are associated with them or the commodities themselves.
Amen.
We're big fans of the direct approach here on the old option block. Well, Kevin, I'm glad you could join us today on the old interview session. And before we wrap up here, is there any other thoughts you'd like to leave our audience with, or perhaps any teases? They'll be listening to this tomorrow morning, so they'll still have a chance if they want to sign up for the webinar. So any ideas, thoughts, plugs, teases you want to leave them with now, here is your chance.
Well, I appreciate you having me on this afternoon, and the lead-in. I'm kind of new to this webinar stuff. And it may be difficult to compete with Candy Crowley, or whatever her name is, and the presidential debates.
You have some scheduling conflicts there.
I do. I ran into a difficult programming environment, but I'd like to think that potentially handled appropriately, that there's greater opportunity on the commodity side of things than 2 hours of political back and forth. So that's probably the best I can do for this one. I'd appreciate the audience, and I appreciate you having me on here this afternoon.
That's the nice thing about webinars, is that they can come back and get them down the road. So after they've had their fill of Candy Crowley and the rest, they can tune in and download it perhaps the following day and listen to it at their leisure. Well,
Correct.
Thank you for that, Kevin, and I look forward to hearing your webinar and maybe having you back on the show again down the road.
Thanks very much for having me.
All right, thank you. All right, and that's going to do it for the interview block. And now we're going to roll right into Around the Block.
Around the Block.
All right, welcome to Around the Block. This is, of course, the portion of the show where we discuss what's coming up, what's on our collective radars for the rest of the week. Kick things off with you, Uncle Mike. What are you watching over there in the land of KYO for the rest of the week?
Well, definitely excited to continue to watch the presidential debates and just see how the markets react to them. And I think right now it's political season, and I'm curious to see if we get some type of a big breakout in the market one way or another. Just when someone sneezes, then if Romney or Obama sneezes in the right direction, we could get a lot of movement. So I'm watching every move that the two potential future world leaders are doing.
The well-known sneeze indicator. I haven't followed that one in a while, but it's been proven to be very useful in the past.
It's right up there with the BBI.
Yes, indeed. All right, thank you for that, good old Uncle Mike Tusaw. And Mr. Sebastian, we're in the teeth of it now. We're right into the heart of earnings season. This is the fun time for options traders. We actually have some potential vol coming up on the near-term horizon, some potential trading opportunities. That's always exciting for us. How many days have we detailed lately where close to close we saw 0.0% movement on the S&P. So the opportunity, any opportunity for underlying movement or vol or anything is exciting for us. And of course, on the 18th is a really earnings Palooza day. We've got Southwest Airlines, Nokia, we've got Microsoft, we've got Verizon, AMD, Google, and a bunch of others that I'm sure I'm missing right now. We had Citi this morning. That was an interesting one that obviously helped the market rally to the upside. We also have, I believe, Goldman Sachs is tomorrow. So any of those names particularly catching your eye, any of those ones that you're watching?
I think Goldman Sachs will be. I think all the names this week are kind of interesting, and really make some decent sense. So I think this is Google is the one I'm really watching at the end of the week. That'll be a fun one. But I think all the earnings, this cycle's going to be pretty important in terms of tone for the rest of the year. There's not a lot of other news, sans the fiscal cliff coming up. So, I just don't see how this isn't really kind of the tone setter for the balance of the year.
Well, we do have a little bit called the election coming up after that, and that might set some tone.
I don't think that's going to matter as much as you think.
Well, I'm not the one espousing the election stuff. It's mostly Tusa, and I kind of fall a little bit. I kind of agree with you more. I think it's going to be perhaps less important than a lot of people might say, just because so much of the market has already discounted whoever is in there. They kind of just tend to work around them, and the policy differences aren't as stark as either party would really make you believe.
The thing is, there are people that think the market would rather have Romney, and I'm not even sure if that's true.
Yeah, that used to be the old saw, rally on Republican, sell off on a Democrat. I don't. That's kind of become much more vague these days. Depending on what they say one day and what they say the next.
And Romney's against the free money from the internet.
The free money from the internet. I love that. You just go to the website and type in free money, and they send it to you from the internet.
Yep.
I know he's against Big Bread. I didn't know he was against free money from the internet.
Shockingly, he is.
Is he that guy telling you on late night TV to go on the internet and make small classified ads and place them all over the place in papers and stuff?
No, that's him. Yeah,
that is him.
No, I think if you listen to what Romney's saying, he's, in theory, now in practice we'll see. In theory, he's, wants to be a fiscal hawk. That also means that you need to borrow less, and he's against kind of the crushing of the dollar. So that's not good for the stock market.
No, and I did forget one name this week on Thursday as well. The one we talked about a lot in the past, has since been crushed quite a bit, is Chipotle, the former stealth Apple, not so Apple-y any longer, also not so stealth. This one closing today south of 300. This one getting some juice, though, going into earnings. People obviously learned their lesson from the last time. People had kind of been trading it very analogous to Apple in a lot of respects and just dumping downside premium because it just worked every quarter, and a lot of them got wiped out over the past couple of quarters. Now we're seeing people actually bidding in some actual juice here. Looking at this Nobel. Actually, I don't even need to look at Nobel because we can roll up to ACK because it's coming up in just a few days. And look, this ACK straddle, the ACK 300 straddle trading about $25 right now, with about $5 of juice baked into it already. So yeah, they're actually looking at some people have learned their lesson, it seems like, in Chipotle. These near-term options being priced at a 100 vol. Granted, they're primarily weeklies at this point, so vol is a relative term. But still, interesting stuff. A fun one to watch. We're always talking about Apple, always talking about Google, Amazon. Chipotle is always one to slip in there. Speaking of Apple and Google, I know in the past we've talked, they were both trading same relative price levels. Apple had a bit of a discount on vol. Google has now since rallied substantially. Apple has sold off substantially. We're starting to see a little bit of that firmness in the upside vol curve that we're starting to see in Apple these days. So where do you stand on positioning between these two? Do you like verticals in Apple versus perhaps something else in Google? Are you washing your hands of Google entirely? Are you buying Google vol right now? You think it's cheap given all this run up? How are you looking in these two?
I do think it's not overpriced. I think Apple and Google both look like deals, to be honest.
We've talked quite a bit about the love that goes to Apple and how it makes some verticals in Apple really attractive. We haven't really seen the same thing in Google. We've seen a degree of it, but I don't think that upside love is as strong in Google, at least not right now, as it has been in Apple in recent earnings.
Well, I think the Apple upside love is certainly not what it used to be.
Yeah, it's certainly sold off quite a bit, but it's still substantial. You can look into some of these different verticals. Like I think we talked last show. I haven't priced it up if it's still there. I think they were talking about the Nove 600 6.5 collar, essentially. The bearish risk reversal you could leg into for actually like a $2 credit. So there is still some juice left in the upside there, but not as much as it certainly has been in recent times. So we'll have to watch this one, see if perhaps there's some opportunities for verticals and other cheap trades on Goog as well. A lot of interesting stuff going on, so we'll keep an eye on that. And unfortunately, that's going to do it for the Around the Block segment and also for this episode of the Option Block. But before we go, we always like to check in with what's going on here with my fellow All-Star panelists. Starting off with you, Uncle Mike Tusaw. What is coming up in the land of KYO?
Well, the webinar train's going to continue to run every Tuesday night. We're excited about that. And tune in tomorrow night, or I guess it'll be tonight now for those of you that are listening on Tuesday morning. Check out, see what Kevin has to say. I know I've been banging the drum for years now in this show about how commodity options are definitely a great alternative if you're looking to trade in the commodities. And Kevin's going to do a real good job of it. And tune on in, folks.
All right. Thank you for that, Uncle Mike. And because even though they're not here, I still like to give them a plug. By all means, surf on over to optionsexpress.com, or even better, optionsexpress.com/OXradio, our Option Block landing page there. You can find out more about the show as well as sign up for an OX account if you like what you've heard on this show over the past 2 years. Then by all means, it's time to kick the tires at OX. And last but certainly not least, Mr. Sebastian, what is coming up in the land of the pit?
Lots of stuff. It's a never-ending trail of interesting things. But, just go check out the blog and give us a call. If you're interested in becoming a trader, that's what we do. So give us a call.
I'm sure a lot of you have seen Mark and Andrew's posts on the Options Insider. If you like those, there's many more of them on optionpit.com. You can surf over there and find them, as well as the link to all their events. I know you guys have something coming up at the SIBO. So if you're into a whole day of vol talk, 8 to 5, I believe it is. That's some serious vol talk.
Yeah.
A whole day of vol talk with Mark and I believe Jim Bittman and the gang over at the Options Institute. Then by all means, surf on over to optionpit.com, click on the events tab, and check it out for yourself. That's you'll get your money's worth there, I think. That's a lot of vol talk. I know I couldn't talk for that long of a time.
It's a lot of vol talk.
You better sip some water and rest the old vocal cords prior to that, my friend.
It'll be a fun one.
All right. And that's going to do it for this episode of the Option Block. But before we go, of course, all of us here on the old All-Star panel want to thank all of you out there in the listening audience for downloading and streaming and subscribing to this show and making it such a success. And for all of you who've been writing in with great questions, we'll get to those on Thursday. We've been really trying to rotate back the old interview block on Mondays, so we pushed some of the questions, the listener mail block, until Thursday. So we'll get to some of those then. So thanks again for writing in and for listening, and we'll see you next time right here on the Option Block.
Become a part of the Option Block. Just visit www.theoptionsinsider.com/forum to post a question for the hosts. You can also submit questions to twitter.com/optionblock or leave a voicemail at 312-544-9356. Make it interesting and your question just might make it on the air. The Options Block is property of the Options Insider Incorporated. All rights reserved. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.